Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by Takahiro Sekido, Chief Japan Strategist for MUFG. It's Monday, March 28th, 2022. Welcome back to the podcast, Sekido-san.
Good to be back.
Always good to have you on. This couldn't be really more well timed. So we're recording this on Monday, March 28th, New York time, which is just a day after one of the most interesting sessions in the JGB market in recent memory. To bring everybody up to speed, as many of you may know, the BoJ announced multiple fixed rate JGB buying operations, although anticipated as the 10-year yield was closing in on the top end of the Bank of Japan's target range, which is 0% plus or minus 25 basis points. I'm not sure anyone would have anticipated it would play out exactly in this fashion. So I guess the question for you is, can you please take our listeners through what exactly happened?
Okay. The Bank of Japan, the BoJ, announced it held fixed rate JGB buying operation twice on March 28th for series 363 to 365 10 years JGBs at 0.25%. Accepted bids totals only 64.5 billion yen in today's operations. About 1 hour after the second operations, the BoJ announced additional unlimited fixed rate JGB buying operation for Tuesday, Wednesday, and Thursday. 10 years JGB rallied slightly following the second operation, while in contrast, yen surged immediately after the announcement of the series of JGB buying operations to the 125 yen level. This supports a bullish bias for yen. At the same time, yen rates have only a neutral bias, and the yen basis could widen even ahead of the fiscal year end because of the increased funding demand for dollar asset positions.
Yeah, but it's really interesting how that went down. You had no bonds, bought at the first operation, then only 64.5 billion yen actually isn't that much at the second observation, and rates don't really budge. So it'll be interesting to see the effect that these three other buying operations have on the market later on this week.
Right.
And that really leads to my next question, which is, what are the implications of today's activity, the future scheduled buying operations? What does it all mean?
Okay. In our view, consecutive fixed rate JGB buying operations were a means of controlling the yen rates other than extended market holiday like Golden Week. However, dollar rates are rising fast, and with a growing presence of foreigners in a JGB market, yen rates were highly correlated with dollar. The rise by yen was due mainly not to more the yen short positions by speculators, but rather to growing current deficit on the Japan side, a slow export recovery, as well as greater demands by mainly energy resource importers to cover dollar yen. The structural reason for current account deficits vary, and they are not likely to turn surplus anytime soon. Thus, the BoJ decided to try its hand at monetary operations to control yields early on. We read the BoJ's move as a message by the BoJ central bankers to all policy board members, including Governor Kuroda, that the YCC operation framework may not necessarily address global inflationary pressures. Over the near term, we think the BoJ could tweak the current YCC operation framework even ahead of the April Monetary Policy Board meeting on April 27th to 28th to in line with the government's inflation measures. If the March Tankan survey due out April 1st, and a BoJ branch managers meeting and Sakura report on regional economies show negative impacts on the Japanese companies from the weaker yen and global inflationary pressures. However, we still see a neutral bias for yen rates, at least at the end of the fiscal year, as the BoJ controls yields through fixed rate JGB buying operations.
Got it. Thanks for taking us through that. So it sounds like there's a possible, some possible tweaks to monetary policy coming up. So we'll certainly watch out for that. Moving on, cross-border flows, securities flows are some of the more interesting, pieces of data, in my opinion. At this point, all of the February investment flow data is out, across JGBs, Japanese stocks, and foreign bonds, with the release of the JSDA data. Could you please share with us what all this data suggests Japanese investors were doing during the month of February?
Okay. In February, Japan's monetary base stayed roughly flat, shrinking by 9 trillion yen due to fiscal factors, mainly JGB issuances, while also expanding by 9 trillion yen from BoJ monetary operations. Current deposit at the BoJ subject to negative interest rate rose by 730 billion yen. In February, major net buyers of super long-term JGBs included lifers by 853 billion yen, followed by foreigners 596 billion yen. However, foreigners unloaded a net 24 billion yen of long-term JGBs, wary of yen rate risk for the 10-year tenor, as they continue to buy other durations. In February, Japanese investors cut their foreign bond holdings and increased their buying of JGBs. Investors were looking ahead to the FOMC raising interest rates in March and the Fed quantitative tightening. Upward stress on yen rates will likely remain deep-rooted. We expect overseas investors to focus more on the front end of the JGB yield curve rather on 10 years. The dollar-denominated JGB yield curve has been flattening, especially at the 3 to 5 year tenor, helped by widening yen basis. Foreigners could show greater preference for short to medium-term JGBs. Japanese companies could continue carrying out their fiscal year 22 direct investing plan from April if the Ukraine war appears to be nearing an end. Japanese investors will likely rebuild their foreign bond holdings after selling off, and a recent US TIC data shows that they have been focusing on US corporate bonds. With the BoJ not increasing buying of EDS, pension funds have been standing out amid the dress of Japan stock buyers.
Okay, so that's what Japanese investors were up to. Why don't we close things with what they're going to do, and let's broaden that a little bit to your outlook across yen rate, spot dollar yen, and yen basis.
Yen's weakening has stood out among G10 currencies. The rebound for US stocks and improvement in risk sentiment, as well as strong yen selling flows among Japanese importers, have been impressive. February trade data shows that exports were up a strong 19% year over year, but imports were up by an even stronger 34% year over year. Over the near term, we expect dollar yen's neutral bias to turn bullish again, with the trading in a higher 3 yen range between a 122 to 125. The yen swap rate curve has risen and steepened. Over the near term, attention will focus on the BoJ's announcement of its April to June JGB buying plans on March 31st at 5 p.m. Tokyo time. The Japanese government has lifted the quasi-emergency measures to slow the spread of COVID. And while upward stress on yen rates has started to pick up. Rates are in neutral mode because of both the BoJ's upper limit of 0.25% for YCC operations, as well as the approaching end to the fiscal year. We expect a neutral bias for yen rates. Venezuela Finance Weekly Securities Flow data shows that over the week of March 13th to 19th, Japanese net owed 15 billion yen of overseas securities, while overseas investors unloaded a net 2 trillion yen of Japanese securities. Japanese turned net buyer of overseas stocks and investment fund holdings by 123 billion yen, helping to drive a global turnaround in stocks. On the other hand, Japanese unloaded a net 111 billion yen of foreign medium to long-term bonds, while net buying 3 billion yen of short-term foreign bonds. Japanese investors have been shortening durations of their foreign bond positions, both before and after the March FOMC meeting. Overseas investors unloaded a net 969 billion yen of medium to long-term yen bonds and a net 538 billion yen of short-term yen bonds. This suggests that foreign investors cutting their JGB positions was behind the widening in front and to belly of the yen basis curve. Over the near term, overseas investors will likely rebuild their JGB positions. We expect Japanese to rebuild their overseas asset positions, focusing on the belly, where yen basis costs are relatively attractive and reasonable. We think the yen basis curve will be volatile, especially on the front end. We expect a widening bias for yen basis.
And that last point is particularly timely given the fact that the new Japanese fiscal year is starting on Friday. So thanks for taking us through that. I'd be very curious to see how things play out with Japanese investors and their purchases or lack thereof of foreign bonds during the month of April. And I'm sure, as always, you will keep our listeners updated on that.
Thank you. Thank you for having me, John.
Always great to have you on the podcast, Sekido-san. And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.